April 1, 2014 Real Estate Capital Scoreboard April, 2014. Chicago, Illinois, April 1, 2014. The U.S. stock market is basking in record-high territory with a challenging task of grasping attractive yields. As for bond and mortgage investors, they must choose a blended approach matching inflation protection compared to slower economic growth. The ongoing glut of real estate capital forces lenders to accept lower spreads, while trying to maintain underwriting discipline. These factors translate to the continued tightening of mortgage spreads over Treasuries, and borrowers are the real winners under such conditions. To better understand the extremely favorable mortgage market conditions for borrowers, trends reflecting Treasury pricing say it all as follows. Treasuries are gradually climbing upward, with 5-year Treasury notes yields peaked at their highest levels not seen since the summer of 2011, while 10-year notes stay in excess of the 2% mark since last May. Funding sources are moving up the risk curve mainly by offering more leverage. Thus, the focus within the industry is on Treasury movements. Should Treasuries stay within a predictable range, more forward delivery and other creative longer-term fixed-rate products will re-emerge. Mortgage spreads as compared to different property types reflect less than a 10 basis point difference between multifamily and conventional commercial property types, the tightest range in recent years, as funding sources see less difference in property type risks with improving fundamentals in supply versus demand for space. With the threat of higher interest rates looming, permanent lenders are liberalizing prepayment privileges for longer-term debt, hoping to remove the burden of lower-yielding debt in the future. With banks, conduits, life companies and other private/public debt funds crowding the marketplace, less pricing differentiation is noticeable, particularly for conservative, lower-leverage loans. Even between various grades of real estate properties, for example, Class A versus B and C, pricing differentials are quite favorable, often quoted within a 50 to 100 basis point range. The overall economy continues improving, with real estate fundamentals enjoying the benefits, says Gene Peck, a director of the Real Estate Capital Institute. Markets are carefully watching Treasuries, particularly short and medium-term maturities, those most commonly linked to commercial real estate debt. Investors may be underestimating how fast the Fed can raise rates.